Hello! Today I'm going to be showing you how to create a statement of retained earnings. This is a continuation of the problem with Schumann Consulting Company that we began in the last video by creating an income statement. So we have all this information on the left-hand side and we're asked to create a statement of retained earnings. Now before we create the actual statement, let's talk a little bit about what retained earnings is. So retained earnings can be thought of as a summary of a company's cumulative net income less any dividends paid out. So a summary of the company's cumulative net income, that means add up all the net income that this company has ever had and subtract all of the dividends that this company has ever had, the payouts to the shareholders. Now, what is the statement of retained earnings? Well, the statement of retained earnings shows how the retained earnings account changed in a given period. So the statement of retained earnings is going to say, well, for the month of March, in this case, how did retained earnings change? Meaning, how did the net income and the dividends change the retained earnings for this period? Alright, so now I think we're ready to go to the details of the statement. So first we need the header, which starts with the name of the company, Schumann Consulting. The second line is going to be the name of the statement, which is the statement of retained earnings. And the third line is going to be for the date, which in this case is for the month ended March 31st. The first line is going to be retained earnings for the beginning of the period, which is March 1st. So if you look over to the accounts over here, you'll notice that retained earnings is actually not listed. And that's because if you read here, it says that this company started on March 1st. So therefore, the company has no past income or dividends. And therefore, retained earnings is going to start at a balance of 0. So we can put 0 there. Next, we're going to add the net income. And the net income is going to come from the income statement. So if we go back there, we can see, oh, the net income is $10,000. So we'll have income of $10,000. Next, we will subtract, or write less, the dividends. And the dividends are given right here. They are $3,000. Alright, the last line is retained earnings for the end of the period, which is March 31st, and that's $0 plus $10,000 minus $3,000 gets us $7,000. So in conclusion here, for the month of March, this company started with $0 in retained earnings. They had $10,000 in net income, which we added. They had $3,000 in dividends, which we subtracted, which ends us with $7,000 for the end of the period retained earnings. Now note that if we were to create a statement of retained earnings for April, the $7,000 would come up here to the first line, and it would be retained earnings April 1st, $7,000. Then we'd add the April net income and subtract the April dividends and find a new ending balance for retained earnings as of April 30th. And we continue to do this every month for as long as this company is in existence.